In the last video, we discussed exactly what signals to watch if the market starts moving. On Friday, those signals played out almost perfectly and the market moved down. And there is nothing surprising in it because this is the exact language of the markets. Now the question is, what comes next? Welcome back to Mind Monastery. In the previous session, we discussed the concepts of leaving value, acceptance, outside value, POC shift, and failed auctions. On 27 March, the market gave us a live example of these concepts in action. So in this video, we will not just analyze this movement, we will also connect it with the exact signals we discussed in the last video. So you can see how these concepts actually work in real market conditions. But before moving further, I will ask you to subscribe to this channel so that you don't miss out valuable learning, because in Mind Monastery, we break down and simplify complex concepts into simpler and easy to understandable language so that every trader gets benefited. I will also request you to hit that like button and share this video to other fellow traders in your community and post your comments below this video, because your comments are a great source of inspiration and which keeps me moving further. The Friday session was clearly bearish and directional. The market opened gap down, it failed to move higher and gradually started moving lower. By the second half, we saw a continuous downside movement with very little pullback. In the last video, we clearly said that watch if price leaves value and does not return. On Friday, that is exactly what happened. The market moved away from the previous value area of 23,300 region and did not come back to build acceptance there. This is the first sign. Market rejected higher fair value and left that value. Then we also saw the second signal, that is acceptance outside value. This is where the real move starts. After leaving value, the key question becomes, does the market accept lower prices or not? In Friday's session, we saw that the prices moved lower, it stayed there and built volume below previous value. This means acceptance outside value. That means it's a real move, not a fake breakout. This was initiative selling. The third signal, which was POC migration, that was also seen. The POC clearly shifted lower. Around 23,100 it started and then it went lower. This is very important because POC shift means that market is now comfortable transacting at lower prices. This is institutional confirmation of the move. The fourth signal, the failed auction at higher levels. Did we see that? This was also a key observation in Friday's market. Price attempted to hold higher zones of 22,950 but quickly failed and rotated lower. This is a classic. Failed auction on the upside. And as we discussed, when one side fails, the opposite side takes control. And then the fifth signal, that is compression and expansion. If you notice carefully, the market was relatively balanced earlier. Then suddenly it expanded downward. This is exactly what we discussed. Energy built and then got released. And on Friday, this is what actually happened. There was a release phase. So where are we now? Value has shifted lower again. The market is now comfortable below previous zones and structure looks weak unless higher value is reclaimed. Now we have to discuss tomorrow's key levels. But before moving to the key levels, let's learn something very important and the next step to the signals we have discussed in the last video. I am talking about the execution part. Once you have identified the market intention using the signals, what we have to do next is to go with the execution part. There is a huge difference between how professionals look into the market and take decisions and execute the trades compared to the amateur mindset. The amateurs usually trade prices. They try to predict market conditions. They jump in when they see breakouts, which often fails, and they operate inside balance area because it looks very fancy, and then they also get trapped in pullbacks, thinking that these pullbacks are actually reversals. But a professional mindset is totally different, and it's the exact opposite of an amateur mindset. The trades are based on value acceptance actually, They first prepare and then respond. I mean, they already have a proper plan with the large capital with them, and they come to the market with the plan, and then they start doing or executing their plan. And they always buy pullbacks, and they operate always at the value edges, and they execute via structure. That means they have certain process which they follow in a very meticulous way, and they always do it so. Now, when it comes to execution, this is a very important part. Where to execute a trade, or where to enter a trade, and where not to. We have already talked about market comfortability areas. The market comfortability areas are comfortable only for the market or big institutions, where they are executing their trades, or they are buying or selling based on their capital, based on their preparation and plan. Where retailers should get interested is at the upper and lower zones of the value area. That is the value area high and the value area low. Because the value area high, in a sense, can be considered like a resistance, and the value area low has to be considered like a support. The edges of the value area are actually existing as boundaries. They are not inside balance. So do nothing inside a balance area, and act only when the auction shifts above the VAH or the VAL. This is something which has to be put into practice. And in one of the learning videos, I have already given a challenge of 21 days, which starts with 7 days and then extends to 21 days, to how to identify market comfortability areas. This can be the next challenge, to stop yourself from trading within this particular zone and trading only at the edges. Now let's understand this particular framework. It's better if you can take a snapshot of this screen and paste it somewhere near your trading desk, so that you don't forget this framework. So the first point is to observe the value leaving a previous value area, but you have to only wait. This is not the time to enter into any trade. The second one, what you have to look is the next signal, which we have talked about in the last video, that is acceptance of value outside the previous value area. If that happens, you consider it as a confirmation. You can add other confirmatory setups, what all you have, which you are trading of now, that can also be added. However, this acceptance outside is a key concept which we have to observe. Once you have observed this particular signal, then you have to wait again for the pullback to edge. If you can understand the framework, whatever we have discussed till now, the first 3 points or the first 3 steps, most of the time is devoted to waiting, and that means you are not reacting. So this is how you start to respond and not to react. Most of the time you will be sitting idle. I know it's a boring thing, but this boredom is what actually rewards. The fourth step is to place the stop loss. When you have waited and when you are trading at your level, you are actually in a very good position to manage your trades in a way so that your stop losses become very small. This is very important. There is a very famous coin toss analogy, which I will discuss in the later video, which will make this concept even clearer. And then you have a target. That is also important, a logical target which you have. What happens is that market gives a nice breakout, and then market starts moving away a little bit from the previous value area, and then there is a pullback. The pullback is essentially towards the value edge. Sometimes the pullbacks can be deeper based on the volatility of the day. We'll talk about these scenarios in a later video. Now, when this happens, the institutional entry also happens. That means the institutions usually enter at the pullback edge, and then have to keep whenever you are entering into any trade. So a complete operational loop has to be followed. Thus, this is what the professional traders do. This is moving from an amateur prediction based trader to a professional trader who takes decision based on sequential precision. So now let's learn this framework in a little more detail. So the step 1 is leaving value. So you have to wait till the market leaves the value. You have to look whether the prices move aggressively away from the point of control or the value area. And then if you can observe that the price does not return quickly, then you have actually found a potential zone where the value has left the previous value. Please remember, you don't have to trade inside the value area. Trade only when the value has left the previous value area, and even then you don't have to jump into a trade. You have to wait for the next step, that is confirming the acceptance. So as you can see, one side you have a real move and the other side you have a trap. When there is a breakout and if there is no acceptance of value, there will be immediate reversal of prices, and this tells you then and there that it's a trap. When you have a breakout and then market spends some time at that particular level, and after spending that time, if you see that a value area is developing, only then it becomes a real move. It's not that the market has given a breakout, it has spent some time in the new area, but the value area is not developing. That is not a real move, that's not a strong move. Then step 3, we are talking about institutional pullbacks. Whenever there is a pullback, there is always a FOMO that develops and amateurs jump into the trade, and their stop loss gets hit during the institutional pullback. So as a retail trader, what you should bear in mind is that never chase strength. Enter on the weakness in a strong trend. And where is that weakness? The weakness is at the pullback towards the value edge, where the institutions actually enter the trade. Now what is the benefit? The benefit is that this kind of entry will provide a superior risk to reward and aligns with the institutional execution, so that your targets get hit easily and in a very fast manner. You don't have to wait longer after taking the entry. Now the step 4. Step 4 is about the stop losses, where to keep stop losses. We have to discuss 2 scenarios here, the short setup scenario and the long setup scenario. For the short setup scenario, a high is a point of reference, and for a long setup scenario, a low is naturally the point of reference. A stop loss has to be always kept above the high, and this is called the invalidation point. So whenever a weakness is broken and the previous high is reclaimed, the invalidation point of the short bias has reached. This exact concept works for long setups also. Now what is the advantage? The advantage is that your stop loss becomes very small. When we discuss about the coin toss analogy, we'll discuss more about it and how this point gives edge to a retail trader. Please remember that a stop loss is not a dollar amount. A stop is the exact coordinate where your structural idea becomes mathematically invalid. We are talking about statistical realities. Now the step 5. Once you have entered a trade and you have planned your stop loss, the next is target. Once you have planned your stop loss, entered the trade, then you have to plan your targets also. Targets can be shifting. It is not necessary that you should always take the first target what you have kept. That is what traders usually call holding a trade. You can hold a trade if your logic fits in. We will talk this concept also in some later video. Now, the logic here is very simple. Basically, you may have several high value nodes and several low value nodes within a value area. You may have 2 different value areas also. One thing while fixing a target is to know this reality that the market moves very fast in low volume vacuums, and then it slows down in high volume equilibrium zones. The best thing as a beginner to do is to target the next structural density. As you become comfortable with this type of trading, you can actually differentiate between the strengths of two high volume nodes and then decide whether to keep the very next high density area as the target or the next to next high density area. These are logical decisions which you can take based on your experience. However, there are methods to learn this also. If you are interested in learning how to decide targets and how to hold on to trades, comment below this video so that these concepts can also be discussed in coming videos. So putting everything together, the framework starts with waiting inside the value area. Then as the market leaves inside the value area, which can be a very aggressive reaction, you wait till acceptance develops. Once lower prices are accepted, that means volume has built in the new level, you have to again wait for the pullback. Once the pullback has happened, then you plan your stop loss, put your stop loss and enter the trade. Remember, during this movement, a low volume node has been created and the first push that the market gets is at this low volume node. So the market will accelerate quickly through the low volume node and reach a particular level where it can stay for some time and build a new high density area or a new high value area. So with the framework in position, the advantage for a retail trader is that we stop predicting. Most of the times we will be waiting and not entering into trades. We will have a preparation phase when the market is running itself, and then we'll respond at very specific levels. I believe that you will follow these concepts in your trading journey and this will add value to your trading. Let's make a few profits. So finally, everything comes to this point that markets don't reward speed. They always reward patience and clarity. Now the key levels for the next session. The resistance level, the most important one is 22,950 to 23,000 zone, which is the previous acceptance area and now it's a potential supply. The support of 22,750 to 22,800 region is the most important immediate level. If breakdown continues, then next lower zones come into play. The bullish scenario can also build up. If the price reclaims the 22,950, 23,000 levels, then we may consider a bullish scenario if value starts accepting above this particular level. Please remember that other than the key levels that we have discussed now, levels also develop as the session progresses. Remember that the upper and lower limits of value area are very important levels which can act as resistance and support. So having said that, we have come to the end of this video, and like every day, if you have found this video useful, please subscribe to Mind Monastery, because here we don't just analyze market, we try to understand how markets actually move using volume profile, auction market theory and smart money concepts. Happy trading.